Hey everybody, it's Mark here at Teslary, and Tesla did close in the red today. It was $251.92 as the closing price. That's a share drop of $4.57, or in percentage terms, that's negative 1.78%. And actually in the morning, as the whole market was selling off, it actually sold off a lot more than you'd expect for a drop in, let's say, half a percent on the S&P 500 in the morning. Tesla dropped over 4%. Negative 4.37% would be kind of the lowest move for the day. It did retrace and actually bounced back a decent amount, almost 2.75%. And that rebound was actually an outperform in some sense when compared to the rest of the market, as the rest of the market was kind of getting bought up towards the middle to the end of the day. And if you're looking at the share price of the S&P 500, you're probably going to notice it was $446 and like a couple cents on the SPY ticker. And that's really just an options play. It was really just them not wanting to pay out what was probably hundreds of thousands of puts below $446 as a strike price. And so that's not necessarily a great look when the market is buying up just to avoid paying out the puts, because it's basically saying, okay, today you kind of won. We're going to let you have a little bit. You better close out those puts as soon as you can, because we're going to buy this up, only to really get rid of it probably tomorrow. Of course, we don't know that. What we really need to focus on is, we'll take a look at it later, some of the little bit of economic data that'll be coming in. And we talked about this move happening today. We can actually just take a look at the S&P 500. Here's the SPY. And this is the move that was done for today. And we said that if ISM comes in a little hot, that we're going to sell off. And that's what it did. So that was something that we were talking about, that in other countries when ISM would be strong, like if it was somewhere in Europe, or if this was in China, if their ISM numbers this week or last week came in much stronger than what they actually came in at, you would see a nice rebound in their market, because their economies are floundering. Whereas it's a little bit different in America, where by all measures, we're actually expanding. Our economy is expanding. We actually are probably right now, we're probably tracking for a 5% GDP for the year. And that might actually be China's GDP gain for the year, where you're seeing a lot of downward revisions to China's GDP to what was like maybe 6% down to 5.5%, down to 5.25%, and so forth and so forth. So when we print an ISM, basically a measure of the service sector of of our economy, when we print a hotter ISM number, it really says that, okay, we have this strength in the service sector that was already a problem in the PCE report, right? So we saw from PCE that core services, ex housing, was already expanding. It was actually not coming in tighter. The jobs were demanding more money, and people had the mobility. They were getting paid more, and you're going to see it even, maybe, perhaps, we don't really know for sure, maybe it reflect even worse as the months go on, as you're seeing all these renegotiations of contracts when it comes to pilots and at United Airlines, maybe drivers at UPS, and what's happening right now are strikes for the writers in Hollywood, and then of course the potential looming strike of the Teamsters at the big three legacy auto manufacturers, Stellantis, Ford, and GM. So if those two last strikes that we were talking about, if those maybe resolve in a way where they're seeing demands being met in regards to pay and benefits, all these type of reflections of a tight labor market are going to really hamper the core services ex housing measures in PCE. It's going to affect core CPI. It's going to basically maybe not say it's not going to imply that we're going to raise rates. That is still kind of a toss up for this year, but it does say that the length of this rate cycle could be, flat for over a year. And what does that do? It's just really it's going to mean that the market's going to be really choppy, maybe choppy to the downside, where there is going to be no reason to be in equities, where rates are going to stay high and depress our earnings. It's going to keep money really expensive for businesses that are really cash strapped. And let's go look at some news, and we'll get back to the charts. So we can I got to do this pretty fast because I got some other stuff that I need to do for my wife. So I know maybe that'll be a welcome relief for some of you guys who really want a shorter video. But let's get over to the news. We'll just run through the news real quick. This is just basically some tweets on X or posts on X. This is really talking about that United Auto Workers Union strike that's going to be going on for up until the middle of this month. So Sawyer just wanted to remind us that we have about 8 days until a potential strike could begin at the soonest. And that's something you might want to watch. How does that really affect Tesla? Well, it could be a real boon for Rivian, Tesla, Lucid, basically EV manufacturers who are not beholden to unionized labor. And there's some other auto manufacturers. I don't think all of Toyota's unionized or some other Japanese manufacturers or even German manufacturers in America. But really for Tesla, it, what does that do for auto manufacturers, the OEMs that are able to produce for some weeks or some months? That could be a great opportunity to be in Tesla, and maybe we'll see some outsized returns, and maybe some of the action that we saw today was reflective of this looming possibility. Let's go over to Jeff Roberts. Jeff Roberts he tracks some activity over at Giga Texas, and he's noticing, and I think Gregor Trug mentioned this as well. They're seeing kind of a slowdown in the overall production numbers for the Model Y, and especially for the Cybertruck, where you are seeing like 9 to 10 Cybertrucks being pumped out every day. That kind of dwindled down to like 3 to 4 in the last 2 days, respectively, and then maybe none tomorrow. And I guess we'll find out. You can follow him on X, but what's happening is there's this maybe some rumors going around where they're retooling the line a little bit. So we know for a fact that, these Cybertrucks are being produced, but it doesn't mean that the line was really fully ready to go for mass production. I think some of these trucks just needed to be produced for possible handover events, possible displays. I know Tesla's going to be attending the, I think maybe the Detroit Auto Show or some other auto shows. So they're going to want to have these trucks ready to show all over the country. And whenever the handover event does take place, they're going to want to have Cybertrucks in sales centers that have a lot of traffic so people can come and look at them. Kind of like what they did with the Optimus robot, kind of stationing them at the really high traffic stores. And when you see these things in person, it kind of really changes your perspective about how you feel about that particular item, because it is a very divisive design on the Cybertruck, and a lot of people look at pictures and say, oh, who would want to drive that? But I think if you see it in person, they know that if you see it in person, you can maybe appreciate the dimensions and the styling a little bit more, and maybe affect the overall reception of the vehicle. But we do also have to understand that there is a large backlog of potential orders through the reservation system of the Cybertruck. So maybe that's not really going to be at play, but there is possible media accessibility and the shows, and of course handover events. So what does that mean for overall production? It could mean that production could take another hit when it comes to this quarter. And Elon already prefaced this and kind of front ran this in the last earnings call, like I mentioned even yesterday. But what we really need to focus on, like when the numbers drop, you're going to see maybe low production numbers, but what you want to convey to people is that, hey, don't panic. This is more about a delivery number thing. What we want to focus on is deliveries. Are we able to get all these S's, X's, and 3s out, considering the type of pressure that rates are putting on expensive purchases, and that the new Model 3 refresh might be killing demand, kind of an Osborne effect on the Model 3s. So just kind of keep that in mind when delivery numbers do come out for quarter 3. So Jay Parsons is... he posts on X, and he's kind of like a macroeconomic analyst, but this is in regards to what is really important when it comes to core CPI. And this is really about shelter costs. This is about housing costs, rents, especially. And you can take a look at the post. It's a long one, but basically the gist is annualized rent growth now nears negative territory as supply ramps. So he's talking about how supply is actually working, that there is more supply, or there's just the demand isn't there, and people are not actually wanting to move out of their home. Maybe you're staying home with their parents, staying in a larger household wherever they're at currently. But rent is coming down, and that's going to be really great for CPI. I think most of the Fed understands this from their own numbers. They're tracking shelter coming in. Jay Powell mentioned this, and a lot of the Fed governors and board has mentioned this already. But this could reflect well and maybe counter core services when it comes to the PCE index reading. So something to take a look at. Inflation is always going, the macro is always going to be really important when it comes to the performance of your Tesla stock, because no matter what happens, you can make all these great Model 3s, but if people don't have money to buy them and the rates to get money to get loans on them are just too expensive, you're not going to have the same demand in an otherwise opposite scenario where money is more easily accessible, rates are lower. It's just a fact. Like the product can be awesome and could sell, but imagine in the same environment if the loans for these cars were 3% and not 8% or 9% or 22% or even more for people with very marginal credit. So it's really important to understand that any rips that you see in stocks are always going to be kind of tapered back, because the performance of their company doesn't counteract the poor interest rate environment. It just doesn't. Rates will really affect stocks more than anything. And so the market's always trying to understand, like, okay, so this new batch of data came in. Okay, so what is that going to do to interest rates? What is the interest rate Fed funds futures looking at? What is the CME Fed watch looking like for rates in November? Those are the real answers that people are looking for to dip their toes back into equities. There's a lot of cash on the sidelines, and we can see pumps from spring into summer, and maybe that small pump in recovery from the August dump. But the reality is all those moves would be larger and more sustained in an environment where the clarity of interest rates, the clarity of inflation, and the global economy is going in the way we want it to go. No matter how you can release 50,000 Cybertrucks tomorrow, but it doesn't necessarily mean that once the backlog of all the reservations are done, that stock can continue going up. It just won't until you address the margins, you address the interest rates. So that's just the reality. And so we talk about hedging, we talk about selling calls against our shares, because people say all the time, like, I read this on Twitter from really hyper bulls, is okay, so if Wall Street doesn't appreciate this, they're really missing out on something like full self-driving AI, for instance. But the reality is they're not missing out on it. If you look at the price action of Tesla, you can always get back in. There's always an opportunity to get back in. For every really strong pump, the retrace is brutal. It's brutal. So if you do want to get in, you don't really have to wait that long. The reality is you only have to wait maybe 2.5 weeks, and you can probably get in. That's just how it works. So you can't use arguments like you're missing out on this. Like, no, they're not missing out on it. You can have a great earnings report and have a great run up after that. But in your heart of hearts, it's going to sell, and they can get back in, and they can go back up when it goes back up. Right? And they're also not scared to buy the breakout. Maybe retail investors are scared to buy the breakout. Oh, Tesla's up 20%. Why do you think the price still goes up after 20%? Other people are buying. And it's not retail. It's not. It's momentum traders. It's fund managers. It's institutional investors. Those are the people that are buying, not retail. No matter what number you want to throw at me. Oh, there's only 41.6% institutional investment in Tesla. Yeah. I know that's low, but the rest of the 40% of the retail that owns and of course I think it's like 20% insiders and 40% retail. Look, you're not going to be able to support the stock. There is, like I say this all the time, there's no evidence from the price action of Tesla that retail can support the share price of Tesla. The only way it goes up is when you get other people on board. So when you're like knocking Wall Street investors and big money, oh, you guys don't understand. Like, well, they do understand, because the only reason it goes up is because they're buying, not you guys. You're not buying enough. That's just like the swing trading that's happening is not retail investors buying 50 million shares. It's not you guys. So Lisa Abramovich from Bloomberg had this tweet that says a Chicago Fed paper finds that most of the effects from interest rate hikes have been passed through to the economy already, and that the current rate levels are sufficient to bring inflation back down to 2% by the mid-2024s without a recession. So there's a lot of people in the Fed that are understanding, like, okay, we can't keep pushing these rates higher without like personally understanding that the rate hikes that we did are still trickling down in affecting economy. We're not here to try to start a credit event. We're not here to make a black swan event where the whole market sells off 20% in 2 days. Like, we don't want to do that. But which is weird, because some of these board members and governors on different Feds in different areas, different regions, essentially, they're still Like they're still contemplating a hike in November. So it's like, okay, we understand. And they're trying to play both sides because they don't want you to just buy stocks immediately, right? They want it to be they want you to understand when you're buying stocks that it's going to be painful. So they're basically saying, okay, yeah, we understand that our rate hikes are still affecting the economy and things can get better, but maybe we should do a hike. And they're always going to say that, like, even if they don't do a hike in September, which they probably won't, and if they do one in November, they're going to, even after the November one, for a fact, Powell is going to say, we're data dependent and we will do it again. We'll do this and we'll do another one if we have to. And all the other, board members are going to say the exact same thing, and they'll go on a media tour, a media blitz, and be like, we understand inflation is looking good, but we want 2%, and we're gonna do everything we can to get 2%, because they're not going to give you a clear sign that they're done. And so you do have to be positioned in some way in that respect. Like I say all the time, like you don't have to be pre-positioned for like an earnings report or some type of event. But when it comes to the interest rate factor, it's like you never know when it's going to be the end. It's not going to be black and white. So if you're waiting to get back in, like let's say September, this FOMC, this is the last hike, it doesn't mean that like you're going to have a great opportunity again. It's going to be front run so hard by the street when they from all their calculations and inside information, they're going to front run the end of the interest rate hike cycle and the beginning of the cuts faster than you can blink an eye, right? So it's something that you kind of need to be. I'm not telling you what percentage of cash and stocks and bonds that you need to be in. That's for you to talk to a financial advisor. But just know, like if someone tells you something, just understand like, hey, I want to dip my toes in a little bit, because what if September's the last one? And I'm not saying it is, but what if it's the last one? So we talked about ISM, and here's an article from FX Empire. It says ISM Services PMI highlights strong growth in the services sector. This report has easily exceeded analyst expectations, may provide additional support to US dollar, which is not a good thing. So key insights. So ISM Services PMI improved from 52.7 in July to 54.5 in August. That means we're expanding our service sector. So anything above 50 is expansion. Anything above whatever the previous month's number is, we're expanding even more. New orders have also grown from 55 to 57.5. Business activity also slightly grew from 57.1 to 57.3. So on September 6th, the Institute for Supply Management released ISM Services PMI report for August. The report indicated that ISM Services PMI increased from 52.7 to 54.5 in August compared to analyst consensus of 52.5. Numbers above 50 show expansion. The index is in expansion territory for the 8th month in a row, basically since the beginning of the year, since December. New orders index improved 55 to 57.5. The Institute for Supply Management commented there has been an increase in the rate of growth for the services sector, reflected by increases in all four sub-indexes that directly factor into composite services PMI and faster supply deliveries. So what is this? How did the market react to it? Obviously, it was very negative because we don't want the service sector to keep expanding, because that means that core is going to keep either staying flat or also going up when it comes to core inflation. So the US dollar index went up. Gold went down. S&P 500 went down. So what does that mean? Well, the US dollar index is basically saying that, US dollar, the yield, it's all going up because, number one, you don't need to be in equities if they're going to raise rates again. You don't necessarily need to be in equities if they're going to keep rates at 5.5 to 5.75%. What's the point? Right? You can be in a short-term bond maybe, but the reality is you don't need to be in anything. When the strength of the dollar has been going up for a very long time, when cash is going up, you can just stay in cash. Like you can get better yield by, keeping cash and going vacation in Japan and getting 50% more value for your money. Right? You can, if you buy a meal in America for $15, you can get one in Japan for like $8. It seems like a better yield to me. So gold, kind of, precious metals are not going to do well in an environment where the economy is expanding, okay? Because gold is considered some type of recession hedge, inflation hedge perhaps. But when inflation is flat and the economy is expanding, why be in gold? I mean, you can just, gold's not going to do anything for you. It's not a storage of value. You're going to stay in cash and just keep cash, and that's going to be from a very short period of time. It's going to be much safer than anything else you can buy, unless you're just buying like a couple weeks, months bills or bonds. And that means like if people are going into cash from equities, dollar index will go up, and then they'll turn that cash into whatever short-term investment they want to do. Let's look at the events that's going to happen tomorrow. So tomorrow we have the jobless claims. So that comes out every week. How can that? So what kind of number are we looking for jobless claims? Of course, we're looking for something that's a little bit higher than expectation. Because if it's a little bit higher than expectation, it means that more people are looking for jobs from jobs they were let go from. U.S. productivity, we're going to want productivity to go up. We want labor costs to go down. But also, we're going to have a lot of Fed speakers tomorrow. Again, we had a couple today. We had a couple just like every day this week. And it's going to be a bombardment. Now, thankfully, some of them are speaking at night, but that doesn't mean it won't affect tomorrow's action. But the overall understanding is that they like what they kind of see when it comes to jobs. They like what they kind of see when it comes to shelter. But they're all going to stay firm in the respect that the inflation needs to come down to 2%, and there's no ifs, ands, or buts about it. And if you don't get any dovishness from these people, like even if a little bit of dovishness actually always gets sold off anyways. Like any rips will get sold. And on Friday, consumer credit, Mary Daly speaks, wholesale inventories, let's look at what Nick Timrose has to say on X. Boston Fed President Susan Collins, factors specific to the pandemic mean that monetary policy may take longer than normal to affect the broader economy. So essentially, this is another board member just talking about that they understand that they did a lot already, but it doesn't mean that they're going to stop, and it doesn't mean that doesn't mean they're going to hike, and they're going to kind of keep you, just as how Powell used that terminology. They're kind of just like it's cloudy, like they can't see where they're going, and they want you to feel the exact same way. So you're cautious in what you buy from just, your regular average day spending to investments. They want you to when you're doing it, that you're going to be very, very cautious. And that's actually a really good thing in some respects. But something they highlight into something they are understanding is firms' cash levels are returning to pre-pandemic trends, and households' excess savings are declining. We talked about this in other videos where the decline of household savings is dramatic, somewhere in the range of almost 90% when you talk to the CEOs of banks who are looking at these savings accounts. Demand should slow as spending becomes more interest sensitive. And this is already something that's already reflected in Tesla, where demand isn't as strong and they're having to do price cuts to keep volume up. They need volume to sustain. They need to be able to produce a lot of cars because that's what keeps their costs down. That keeps people going, keeps their factories always running. You always want your factories going, as much as you can. I know they're only running like 2 shifts out of 3 possible in Berlin, in Germany. That if you could run that factory all day long and produce cars and sell every car you make, that's always going to be better, obviously. All right, let's go back to the charts. So we looked at S&P 500. This is the daily chart. Well, I mean, the action for the day. If you want to be optimistic, maybe you see essentially a inverse head and shoulders. Maybe you see maybe the jobs number comes in tomorrow and it's good. I mean, good is going to be, like I said, maybe slightly more than what people are expecting, right? But that all those moves that are very bullish can always be sold off by some Fed member talking their book. But this is a possible move. But also the other move that could be just as important is how they're really testing this $446 strike level for the daily expirations on SPY options, QQQ options as well. They were just trying to manipulate this as much as they could, just to not pay out all the puts. There was hundreds of thousands under 446, so they just didn't want to pay out those puts. That's the only thing. So if the only action you're doing is not to pay out puts, that's not really great. That doesn't show bullishness. It just shows you're just trying to get through the day and make some money or not lose money and let tomorrow happen the way the market wants it to happen. Let's look at Apple real quick. Apple sold off severely. So Apple, this is a chart of Apple. Apple's in the candles, the red and green candles. Light blue is going to be NVIDIA. Tesla is in yellow. And the SPY or the S&P 500 is in also yellow. So you can see the two yellows are definitely outperforming what are two very large members of the index and of other indexes as well. But you can see how flat and lower lows, so flat for NVIDIA and lower lows for Apple throughout the day. It did, got bought up at the end of the day, but that could just be really just to affect the SPY price, to get SPY and the QQQ go up to the number they want. It's easy to move those stocks. It's really easy to move the index if you're just buying Apple and like NVIDIA and Tesla, because it really affects the price of the index because their weighting is so heavy. But also, towards the end of the day, Tesla didn't necessarily see a lot of buying. They're just using Apple and NVIDIA to kind of move the price in the way they wanted to, because Tesla is already being bought. So if you're looking at the SPY, top yellow line, and this kind of higher high thing with Tesla, so Tesla sold off to the same severity as NVIDIA, to the same severity as Apple. It was like over 4% down, and NVIDIA was kind of the same, but NVIDIA did not get bought back up. Apple did not get a higher high in, and didn't take any significant highs from earlier on in the day. So why is that? Well, and this could be another reason for the market being dragged down so severely, is that there's a lot of rumor circulating about NVIDIA. I just don't think it's that true, that there's these ghost customers, phantom customers that are quote unquote buying these chips. And so people are trying to talk NVIDIA down. I think ultimately this is just, it seems like a lot of baloney to me, but no one really knows, obviously, but people are very skeptical about the explosive growth that NVIDIA has. I just don't think I don't think it's something you need to be really skeptical about, because, if you want to do your own AI compute, you're going to spend hundreds of millions of dollars. So how many business customers do you need to create, $13 billion in sales? So let's say each business spends $250 million, which will get you about 10,000 chips. So it takes 4 businesses per billion. So 13 billion, let's say you need somewhere in the range of, 50 to 60 corporations buying 10,000 chips each. And by the way, China was still able to buy some of those chips. We know Saudi Arabia was trying to hedge their future by spending a lot of money on chips as well. And not to mention our domestic, all the domestic tech competitors. They need to one up each other. We're talking, the Google, Microsoft, that's going to be a rivalry when it comes to search. We know Facebook, they already have a very effective AI when it comes to recommendations, and they're going to want to expand that AI into Facebook advertising, and of course expand the Instagram model as well. They're going to want to expand the product offerings when it comes to like agents. I think agents is going to be a big thing for Amazon and and Facebook as well. Agents that are going to be able to maybe guide you in some type of purchasing decision. Those are all really, really big things. And of course, Tesla's needing as many chips as they can. They already have 10,000, right? They can make their NVIDIA compute data center already, but they're still open to buying more. And every company is really in the same way. There's startups some of these startups are, they're raising hundreds of millions of dollars from venture capital. And the whole purpose of that is just to buy chips to start up their own compute for their company. So every dollar that all these new startups are getting is just to buy chips. And even to the point where like venture capitalist companies are actually just using the money that they would have given to their startups, and they're just buying chips themselves, creating their own compute, and then licensing that out or leasing it out, or letting their new startups use the compute that the venture capitalists own themselves. So there is demand there. So I just don't understand it. But for people who are very bullish on AI, all these pullbacks on NVIDIA, I mean, maybe you buy a share or two. I don't know. But you're seeing how Tesla got bought back up a little bit. It wasn't a severe drop like the other names that got hit really hard. Apple, on the other hand, like you're seeing there was an article that came out that, the Chinese government officials aren't to use Apple products anymore because they're worried about, being listened to, quote unquote, spied on. But the reality is there's also news coming out that, Apple is cutting back orders for chips from TSMC, meaning that maybe the demand for a certain type of product is not really there. But all of this can just be FUD so people can really get into these names at much cheaper rates, especially when it comes to Apple, because we have an Apple event coming up next week. And so if you see yourself in the 180s or lower, maybe that's a long for the people that really know what's going on with Apple. Let's look at yields. So the 10-year is doing what we thought the 10-year would do. So we're seeing this possible, what I think is a diagonal kind of head and shoulders type of situation where we drew this green line a long time ago, and it's following exactly what we thought it was. We drew the blue line. This is what we thought the action could look like. It's going to be like a flag, basically. And it's basically doing that now. And if this continues to make higher highs on this shoulder is going to be completely invalidated, and you'd actually want to more focus on a channel, something along the lines of like this new pink line, where you're going to be looking for some crazy, ridiculous highs, somewhere in the range of 4.5% on the 10-year, which would be devastating to stocks. Just absolutely devastating. So why are the yields going up? So the yields are going to go up because if the rates are going to stay here for over a year, no one wants to be in equities, and they're going to demand that the rate that they get into these from bonds or in bills, it needs to be higher, and they're going to force their hand. They're going to sell all the bonds off until they get to a yield that they like. You're hearing a lot of people saying that the yield is just not high enough on the 10-year, so they're just waiting, and they're just waiting in cash. And as they wait in cash, if there's a consensus from all the people that are managing money, all these bond traders, if the consensus is, we know these yields are going up, only because they want it to go up, and they're going to make it go up by not buying them, and then thus the dollar goes up, stocks go down, and when the yield gets to a point where they like it, they buy it. But they're going to force the hand of this market. Looking at TLT, it's kind of also doing what we want it to do. So we've been talking about TLT. It's basically just the inverse of a bond. It just tracks the performance on long bonds, 20 and 30 years. And we drew this kind of inverse head and shoulders, thinking that this could be a bottoming process for a long bond. But the problem is, and then so even though it is kind of following what we might think it is doing, where we want it to fill the gap, it's pretty close, maybe it will, and then we want it to get bought back up. But I'm not saying I'm super bullish on TLT. I'm just saying that, yes, it could be forming a very classic double bottom. But I want you to understand when it comes to yields, when it comes to the bond trade, that, look, this could be, if yields stay where they are for a long time, this you can see right into the 80s. You can see TLT right into the 80s. You're going to see long bonds get bid up. The yields just go up, and it'll send Tesla crashing into the ground. Just want to let you guys know that's how it's going to work. If you see TLT make new lows, if this doesn't respect that this is a double bottom, you might as well just book it. Like, you can say the year's over, there's not going to be much hope. You can try for an October rally into the fall, but that's your only bet. I mean, and you can just do that with a couple bucks. You can buy a couple QQQ calls and just go to sleep. And if it works out, it works out. If it doesn't, oh well. And then you don't have to worry about it. You don't have to worry about the day-to-day, machinations and all this movement. If bonds are making new lows, if TLT is making new low, if the 10-year is making new highs, and if it's following an upwards trend and it's keeping that trend, you can just say to yourself, like, okay, I'm done. I'm going to stay hedged, and I'll go to sleep. And when the end of September comes, I'll buy a couple calls going into November, and I'm going to go back to sleep. And because that's all you kind of really need to do. The day-to-day movements are not going to work out in anyone's favor. Okay, so we're back at Tesla. That's why we're here, obviously. Let's just kind of look at how this action really worked out. And so we haven't touched the chart. The levels are being respected. So first thing, let's talk about, from a short-term trend, we're still managing the uptrend, right? From the gap up, we drew a simple diagonal line, and it's been hitting over and over and over again, and we're bouncing off it. We can extend it now. Let's just extend this and see, and so we can get a better idea, how this price actually works out. If it falls below it, then we can start looking at how the patterns are being formed for something that might be a little bit more bearish, or something that's going to be just more of a consolidation instead of trying to manage an uptrend, right? We're just going to be more sideways instead of pretending that we're bulls. But let's look at the price. If you were to be short, let's say you went short yesterday and you have a hedge on your shares. If you saw, and if you kind of have the same chart I do, kind of watching this uptrend, tracking these horizontals, which are, the kind of roundabout strike prices that kind of make sense when it comes to, like, if you're a market maker, like, I want to sell a bunch of like $245 puts. Well, I'm not going to let this touch 245, right? I'm not letting the market go down to 245. I'm going to stop it. I'm going to have a bunch of orders here. I'm not going to let the market destroy all the puts I sold. And so it gets bought back up. And you're kind of seeing that movement just kind of fluctuate between roughly the areas of interest that are just based off strike prices that you can probably think of yourself. 245, 250, 260, right? Makes sense? Like, this is not rocket science. And you can see how it isn't. We haven't touched these yellow lines in a very long time. So just like the day before, it bounces off the 242 and gets bought back up. And where does it kind of struggle? It struggles around the 255 strike, which is where I believe, for my own calculations, would be like the upper estimated move for the week. And then, of course, it gets sold off due to bad ISM data, or good ISM data, quote unquote. And it finds a base at what? 245, but also an intersection of the upward trend line. So if you're watching that and you're seeing the price fall to that point, that would have been a great long. And or like I said all the time, you don't have to go double long on your stock. You're already long. You could just close out a hedge or two, take profit on that, and let your stock ride back up without your hedges getting devalued, right? But if you're looking at the stock, like, where do you think this is going to stop at? Well, where did it stop at? It stopped at 251, right below the 252 strike. So this makes sense, right? So 250-ish, right? So if you saw the move, and let's say you caught a move where you're from, let's say you didn't enter perfectly. Let's say you enter at 246 and you're somewhere kind of straddling 251. You just got a 2.3% move. That's where you just take it off. You take your long off there, you scale out there or something like that, because that is a very, well-respected point in pricing. You found some flagging in it on that area before. You found some buying from that area before. You saw that being a ceiling in a small flag from before. And so, these levels that I watch, this is, look, no one's reading the future. It's just what makes sense when it comes to, if you're going to sell a bunch of options to people, you're going to just probably sell very round numbers, because from a human perspective, you're going to track 242.50 or you're going to track 245. You're probably going to just buy 245. You probably don't even look at the intermediate options. You're not looking at like the $3 increment, the $3.33 increments, or the $2.50 increments. You're probably just going $5.55 increments, and that's how the pricing is kind of respecting the options at the moment. So it can also kind of give you some information about what the max pain could look like at the end of this week. So basically, watch the options chain, see where a lot of the action and interest is at, and it can kind of pinpoint, it can give you an idea of where the pricing might end up being. But we're kind of still in the middle between the lower and upper EM for the week, so we can still range all the way through this. We don't want to go really below like 247. We don't want to close below that, especially. But we also don't want to see pricing drop below 247 as the week goes on to maintain this upward trend. So if you see a negative 2% print for Tesla tomorrow morning, you might start understanding, like, this is either going to be the bounce, or this is going to be where we start breaking down from our uptrend. And then you start looking at the pricing. You're like, okay, we're not looking at an uptrend anymore. We're looking at consolidation, or we're looking at this is Tesla's topping pattern. So we'll go ahead and just draw a line. So when it comes to like tomorrow morning, like if that happens, you kind of want to stay up and try to keep above the trend line. So maybe that's going to be some middling bearish scenario. What's even in a worse scenario? Let's say there is much less less jobless claims than expected. And that can imply that the labor market, from all that stuff we got from last week, was actually maybe not, as solid data as we thought, all that soft jobs data. What if you see jobless claims coming at like 190,000? What do you do then? Well, you probably might see a violent reaction when it comes into the morning, and you're probably going to see Tesla trying to struggle to stay like above 240 or something like that. What's a really bullish scenario? I mean, maybe it's tonight we see some action in the Asian markets that maybe lend itself to some type of stimulus from the Chinese respect, or we see some type of good data coming out of Europe. Probably not. Europe is not looking good at all. Europe is really dragging us down too. But let's just talk about what it looked like a bullish move would look like. It looked like probably a slight gap up, and probably a reject from 255. So if it's bullish, maybe you see some buying in the morning. It gets to 245 and does nothing. Possible. If it's really bullish, well, that's great for everybody, right? But the overall sentiment in the market is that yields are just so high and people are wanting to stay in cash again because they're not getting the data they want when it comes to other countries' economies expanding, that our labor market is coming in cooler, and they're going to stay in cash. They're going to buy bonds when the yields go up to like 5.5%, and they probably would just dip their toes in that because, what if if inflation doesn't cool down with energy costs going up for week after week after week, what do you do? Like, I mean, inflation can go up higher, so they're just staying in cash even longer, maybe into November, waiting for good prints for PCE and CPI to come out. What do you do in that scenario? Well, you're seeing an energy trade that's picking up steam. Maybe it's already tapped out. Maybe the energy trade's over. But there's still a natural gas trade. There's still a gas company trade. You have the likes of AR, which is like Ontario Resources. You have EQT. You have you can have the export business side, which is going to be like LNG, which is a ticker LNG, not liquid natural gas itself, but Cheniere Energy. You can go with tankers. You can go with dry bulk shipping for coal. You can go with the LNG tanker manufacturers like FLNG or Golar LNG. So it's kind of two different. Like if you look at the trade from last year, like, okay, so inflation is going up, energy costs are going up. How do you hedge buying, energy more expensive to heat and cool your home, to fuel your car? Well, you go long energy. As I think some recessionary trades are not going to come through unless something drastic happens. So I don't really care about utility trades. But yeah, I mean, so you can kind of play both worlds when it comes to like, look at Tesla as, okay, so Tesla's an energy name too. Where if oil goes up, like why won't people just buy EVs? Something to think about. You should try to like map Tesla over oil and just kind of keep a track to see how that moves each other. But unfortunately, energy doesn't overcome rates. And if rates are high, car sales will be lower than what they could be. Even if Tesla's expanding and growing its sales, doesn't mean that the margins it's getting would be the same margins in a low interest rate environment. You see definitely higher margins in a lower interest rate environment. Is there anything else we need to touch on? I mean, since it's past, we're actually in futures territory, right? Let's look at the US 500 to see how we are reacting there. We're flat in the futures. I don't think the Asian markets have opened. Let's take a look at our sector, and close out there. Let's look at the automotive sector, and we can kind of glean some information here. We're seeing Ford, Tesla, and Rivian here, orange, yellow, and light blue. Kind of better performance than GM, better performance than Stellantis and Lucid. They didn't do as well as far as the recovery during the sell-off from the morning. Ford had a little bit of decent news with some growth in the EV sector. It was like 18% maybe. They had that was sale numbers year over year. Rivian and Tesla, just because they might not be affected by the UAW strikes, so maybe they have a little bit more interest than the original equipment manufacturer, legacy auto manufacturers. All right, guys, I think that's it. Thanks so much for listening, and have a good night.